This was the week where the death spiral kicked into a much higher gear. The more Bitcoin goes down, the more stretch goes down, the more strategy goes down, the more losses investors have, which means the more investors who file lawsuits, and the lawsuits are for more and more money. You're going to have tens of billions of dollars that strategy is going to owe investors in these class action lawsuits. I mean, you get crickets now at CNBC. I think they got some liability. I think they're going to get sued. I think the financial journalists that enabled this, that should have known better, they legitimized this scam. They're probably going to get sued too. I did a podcast from my boat, and the title of that podcast was The Death Spiral Has Begun. And the death spiral referred to shares of strategy. And the reason I believe that strategy was entering a death spiral was because the share price of their flagship preferred stock, Stretch, STRC is the ticker symbol, had broken below 100, which was the par value of the shares. And I think it closed around 93 to 94. So that was a significant breakdown, because the idea behind Stretch was that the share price would stay at around 100. That's why it was being marketed as a secure income-oriented investment, because your principal was pretty much locked in because the share price was going to remain at 100. Now, I had been criticizing the marketing strategy behind Stretch since the inception, because I called it a Ponzi scheme, which is exactly what it is, because the mechanism for paying the dividend, the 11.5% coupon or preferred dividend, was not the income being generated by Strategy as an operating company, because Strategy didn't generate any income. It was really losing money. There's a tiny software business beneath a pile of Bitcoin, but that software business can't support the 12 trillion, 15 trillion worth of preferreds, plus there's another 15 billion of preferreds. And there's another, 5-6 billion of convertible debt. I'm not sure the exact numbers, but the software business can't support that at all. And the money that Strategy was counting on to pay the dividend obligations to the preferred was going to come from selling more preferreds. That Saylor would keep on issuing through Strategy more preferred stock, and as it raised money, it would use some of that money to pay the dividends on the preferred, and it would use the rest of it to buy more Bitcoin. And it would keep on doing that, growing its Bitcoin per share and raising the money by selling Stretch. And the reason that Saylor claimed that he could do this, that he could afford to pay 11.5%, was that Bitcoin was going to appreciate by 30% a year. And because Bitcoin goes up by 30% a year, he can afford to give the first 11.5% to Stretch and take out all of the volatility. So that there were two securities, one Stretch, no volatility, $100 price, 11.5% yield, and then common stock, Strategy shares, no yield, but the rest of the upside. Strategy was going to get the other 20% plus, giving the first 10% to Stretch. Now I said, look, this is ridiculous. Bitcoin's not going to go up 30% a year. There's nothing you could base that on other than looking at the return from inception when Bitcoin started at nothing. But the most recent 5-year period, Bitcoin has gone sideways. There have been no returns. In fact, Bitcoin today, and it closed just below 60,000, is lower than it was in April of 2021. And its high that year was in November of 2021, but we're lower than that too, obviously. So you have 5 years where Bitcoin has gone down. So how can you say that it's going to go up 30% a year when recent history doesn't bear that out? But anyway, the entire premise was built on this fantasy, but the funding mechanism where you get the money to pay old investors by selling stock to new investors, that's a classic Ponzi scheme. And I called Stretch a Ponzi from day one. And the main reason people argued with me and claimed that it wasn't a Ponzi was because Saylor was acknowledging that. He was admitting that that was how the money was being raised. Now, he didn't call it a Ponzi. He just described a funding mechanism that is exactly a Ponzi. And just because you're upfront and admit it's a Ponzi, again, not using the words Ponzi in your admission, but admitting that you're funding it exactly the way Ponzi's are funded, that's what differentiates a Ponzi scheme from a legitimate investment. A legitimate investment, the investors are paid out of the profits of the business. The business generates a profit, and it uses those profits to pay investors. In a Ponzi, there is no profit-generating business. You pay the old investors by raising money from new investors. And the reason that's illegal is because eventually it collapses. It can't go on indefinitely. And so I pointed out that just because Saylor admits it's a Ponzi doesn't mean it's not a Ponzi. It just means that the people who are participating in it are that much dumber for actually knowingly going into a Ponzi scheme. And I pointed out that normally the telltale sign of a Ponzi scheme is when the yield is too good to be true, right? And that was the case with Stretch because the yield is 11.5%. How could that be the yield? Junk bonds don't even yield 11%. And everybody knows junk bonds are risky. Saylor was marketing this thing as conservative, as appropriate, suitable for retirees who wanted to preserve their principal. So clearly, a conservative investment is not going to pay you 11%. That's too good to be true. That's generally all you have to indicate a Ponzi, because the promoter of a Ponzi pretends that the yield is coming from an actual business. You know, when Ponzi himself created the first Ponzi scheme, of course, it wasn't called a Ponzi scheme yet because he was the first one to do it in a big way. But he had a scheme where it was trading postal coupons. And it was the trading of the postal coupons that he was doing that was supposedly enabling him to pay the investors. He didn't admit that he was getting money from new investors to pay the old investors. That was the Ponzi beneath the fraud. Same thing with Bernie Madoff. Bernie Madoff was generating these 10% annual returns, something like that. But he claimed it was his stock trading strategies. He had fake confirms and option trades or whatever, where he was pretending that the money came from legitimate sources. But with Saylor, they didn't even have a pretense. They came right out and told you it was a Ponzi, except they told you in the fine print of the prospectus, because all of their marketing material, everything that they used to promote Stretch, didn't mention all the risks in the fine print in the prospectus. It just said that this is safe. This is for retirees. You're going to get 11% a year. We've stripped out the volatility. So if you want risk and you could take volatility, buy Bitcoin, buy a strategy common. If you don't want the risk, if you don't have the stomach for the downside, then buy Stretch and just live off this great 11% yield. It's better than a bank, better than a CD. It's better than a bond. So I called that out as BS the minute I heard it, right? Just like when I did that debate with Yashinsky at Celsius, and I knew right away that what he had was a Ponzi based on the way he described the returns and what he had, and I ended up being right. The government figured it out. I don't know how much longer it took him, but eventually the guy went to jail for doing exactly what I accused him of doing, just based on one debate. Well, what Saylor is doing is even bigger, and so it's worse. A lot more people are going to lose a lot more money than in Celsius. But anyway, so I knew that. But what happened 3 weeks ago when I did my podcast, when I saw the preferred break below 100 in that way, I knew it was over. Because in order for Saylor to get the yield back up or